Hello and welcome to the Broadcast PR Business Investment Predictions 2013. We have with us in the studio today Mike Franklin of Beaufort International Associates. We have Julien Seetharamdoo from HSBC Global Asset Management, and we have also Mark Gregory of Ernst & Young. So if I can start with the first question to you, Mike. Looking back at 2012, you made some sort of predictions for some nasty mines that might be sitting in the water for investors. Would you just like to recap on those?
Not really, no. No, it wasn't too bad, actually. Iran obviously was something that was looking quite tricky at the time, and I think it still is. No one knows sure quite how the election that we've just had in the States is going to pan out for that and the relationship with Israel. But that is still something that could come to haunt us. And we've seen the oil price all over the place this year so far. I suspect we're going to see more of the same on the back of that.
And what about the Chinese housing market? That was one of the nasties that was facing investors last year.
Yes, that's right. In fact, I was out in China at the end of the previous year visiting a manufacturing company out there, and you could see there's an enormous amount of property coming on stream, commercial and residential. And having lived out in Asia, of course, I know from past experience that these things can sort of sit for an awfully long time before they find an end user. The problem I find with China, and I suspect a lot of other people do too, is it's difficult to get hold of the relevant statistics for these things. And we know there have been dislocations. We know that in certain regions there have been difficulties in moving property because the regions actually have to raise money that way, and that's a problem for them. So we're seeing an adjustment, but it's a bit painful.
An adjustment. I mean, Julien, are we going to see a harder landing than expected for China?
That was certainly the concern through most of this year, was the extent of the slowdown in China. And it was driven really by two things. One was the domestic slowdown, which was deliberate because the authorities were trying to slow the economy down because a housing market bubble was taking place. But on top of that, China also experienced a headwind from what was happening in Europe, with a slowdown in Europe. And the European Union is actually a larger export market for China than the US is. So the combination of those two headwinds was obviously a significant problem for the Chinese economy through most of this year. But we would also emphasise that in the past couple of months, we have started to see signs of stabilisation in some of the economic data coming out of China. For example, industrial production has started to pick up, and also some of the survey evidence, such as the manufacturing PMI surveys, have also started to improve as well.
So some improvements, but some impact on Europe. So perhaps if we could talk to Mark about the European Attractiveness Survey, which I know Ernst & Young produces on an annual basis, and you've got a 6-month update on that, haven't you? Perhaps you could tell us a bit about that and about China.
Yes, so inward investment remains a good story for Europe. It's 4% up this year, and was up last year as well, so first half of the year. China has become an increasingly important driver of that growth. It's a lot of the incremental growth in Europe. So China now accounts for 4 or 5% of FDI into Europe, but it also accounts for a third of all foreign direct investment into Germany. So we are starting to see, as Julien was talking about, these two-way effects of trade. We were talking about decoupling a little while ago in terms of regions of the world. That clearly isn't the case, and the knock-on effects are there, clear to see. So if China slows, inward investment would slow as well.
Okay, and can I ask you too about American investment into Europe? Is that likely to go up? I mean, there's the fiscal cliff waiting.
Sure. So America is the biggest investor into Europe. Traditionally, 25-30% of all foreign direct investment into Europe comes from America. And that's dominated by three sectors: business services, software and financial services. The first two are holding up well, and business services is growing pretty significantly. Financial services was down 10% last year. It's down another 7 or 8% in the first half of this year. So it's a mixed story. It's probably less about the performance of the US economy than the structure of both the US and the European economy.
If we can go back to Mike, perhaps you can give a view on investing from America.
Basically, investing, how they're going to run this year, or next year, I should say. You're thinking 2013. I think I think we're going to get an element of what we had this year in terms of the volatility. I mean, for instance, you take these S&P 500 index as a proxy, had pretty extreme moves during the course of the year, and your timing had to be quite good to really make a sensible return out of it. Having said that, the index overall is up about 16%, I think, net at the moment, but although it's had a bit of a torrid week. I think that on this, my approach is basically you have to identify specific situations. I'm rather a bottom-up man here. In terms of economic growth, we're probably looking about 2% again next year of that order. But having said that, I think corporate earnings could start to pick up towards the end of the year, because you could get into a virtuous cycle in that if confidence does start to come through on a consistent basis, then corporate America will start to invest more heavily.
And are we going to see American companies starting to invest in emerging markets more assertively? Julien, do you feel that is that going to happen?
Well, I think we've probably seen that happen to some extent already. I mean, we tend to look at things more from the point of view of equity investors or bond market investors, and we think that a lot of emerging markets now are trading at quite cheap valuations if you look at their PE ratios relative to long-term averages. So, for example, we were talking about China, and China's PE ratio at the moment is around 8, forward 12-month PE ratio, and its long-term average over the past 10 years has been around 11. So there is potential there for an improvement in given where valuations are at the moment, if the economic outlook improves for those countries.
Okay, and if we can go back to again investment in Europe, are we going to see any better news for Spain? It's had huge problems from an employment point of view, but its FDI was up in 2011.
Yes, so Spain is a slight conundrum in that it's performed extremely well in terms of foreign direct investment. When we look underneath the surface of that, manufacturing has been quite a big driver, so there is some evidence that it's the preferred location in southern Europe for foreign investors looking into Europe, so there's quite a bit of US investment goes into Spain. It does have, with its economic problems, available workforce, so actually for foreign investors the economics of attracting may not look that bad, even if there is obviously some short-term concerns. But our big question for Spain, and it remains a question, is how long the lags are in foreign direct investment. Decisions are taken at some point in the past, projects are now completing, but when we look forward to 2013 and beyond, it's unclear if, as those lags run out, whether the past year's experience will mean Spain will start to struggle with foreign direct investment. But for the moment, it looks very healthy.
So can I ask you a general question for any of you? Do you see particular areas which you would put your money behind without giving a tip, but for 2013?
Well, my only feeling on this is that the US is starting to shape up quite nicely, and assuming that the politicians can sort themselves out and get the debt negotiations resolved fairly quickly, then I think the US is looking quite good for 2013. China as well, they've got the new leadership now coming in. I would think that there will be probably some quite positive news to come out of that, but it's never plain sailing with China, so I'm sure Julien agrees.
Julien, would you add anything to that? I mean, you're a big investor in China.
Yeah, I would agree. I think we like China on a valuation perspective. We think a lot of developed market equity markets are also attractive, especially the US, where we as long as the fiscal cliff is resolved and the underlying economic data in the US is actually showing some positive momentum. And then finally, I'd probably also add that we think Russia's an attractive market because it enables investors to hedge an increase in the oil price, because the Russian market tends to move closely with the oil price. And also Russia's entering the World Trade Organization this year as well, and that then allows more foreign direct investment and opening up of markets, consumer markets as well. So medium to longer term, there are also some other positives of Russia there.
Okay, well,
inward investment-wise, the US, I agree with the sentiment on the US, and that drives business services, drives software investment. So that would be for me two hotspots. And the one other surprising thing from the survey out today is a resurgence in Central and Eastern Europe. We've been quite worried about that region with the banking sector and some of the spillover effects, but in terms of foreign direct investment and particularly job creation, they've had a very good start to 2012. So that may be a new emerging opportunity.
So worth looking at the Ernst & Young attractiveness survey for Europe, and you may find some surprises in it.
Yes,
and
it's half a year, but nevertheless.
All right, well, thank you very much indeed for joining us. Thank you.